So this is our first pattern that we're going to take a look at, and it's called the bearish engulfing bar. So the engulfing bar is formed when it fully engulfs the previous bar. So what do we mean by fully engulfing? It just means it fully covers the other bar. So this one, as you can see, it fully covers this small bar right here. As you can see, the price is literally above. So as you can see, it's above that candlesticks and it's below that candlestick. So this one is basically covered. It's fully covered, fully engulfed, and that is what we mean by engulfing the previous candle. So the engulfing bar can engulf more than one previous candle, but to be considered an engulfing bar, at least one candle must be fully consumed, like this, as you can see with this demonstration right here. The bearish engulfing is one of the most important candlestick patterns. The candlestick pattern consists of two bodies, so body number 1 and body number 2. So we're looking for this to be fully we're looking for this candlesticks to be fully engulfed by the following candlestick. So the first body right here is smaller than the second body, and in other words, the second body engulfs the previous body. So as you can see, this is the smaller body, and then this is our opening price and closing price of our bigger body, which engulfs the smaller body. This is how a bearish engulfing bar pattern looks like on your chart. So this candlestick patterns gives us valuable information about the bulls and the bears in the market, so about the buyers and the sellers in the market. This bearish engulfing pattern below tells us that the sellers are in control of the market. So this is the candlestick that we're talking about right here. So here we're looking for this pattern like this, exactly like this in the market. So on your chart right now, so here is an example, a clear illustration of this example right there. So the bearish engulfing patterns is now telling us that the market are actually in control of the market at the moment. So when this pattern occurs at the end of the uptrend, so this was an uptrend right there, as you can see, the market was actually going up right here, and then when it came to this point, it created this bearish engulfing right here by fully engulfing this candlestick, this small candlestick right here, with this new candle, with this new bearish candle. I call this a bearish engulfing because it fully engulfed the previous small candle right here at the, just before it. So it's now a confirmed bearish candle. As we said, it needs to engulf at least one candlestick, at least one previous candlesticks needs to be fully engulfed. So when this position occurs at the end of the uptrend, this indicates that the buyers are engulfed by sellers, which signals a trend reversal. So now the trend, we're now expecting this market to actually go down, and that is exactly what happened. As you can see right now, the market started going down. So this is exactly why bearish engulfing candles are very, very important in our technical analysis. So as much as it is important, you need to understand that you cannot just trade any bearish candlestick pattern that you find on the chart. You need to confirm it with other technical tools to confirm your entries. So as we go through, you're going to understand some of those that you can put together with this pattern right here, which we make use of to anticipate a trend reversal, because buyers are no longer in control of the market and sellers are trying to push down the price market. So together confirmed with other technical tools that we're going to make use of, you basically have a confirmation to say, okay, cool, this is a perfect entry for selling the market. So the opposite of this candlesticks, of this bearish candlesticks, is called the bullish engulfing candle. So we're looking for exactly the same pattern, but then now we're looking at in the opposite direction, and we're looking as a sign of end of a downtrend, and now we're going into an upper trend. So this is how the bullish candlesticks basically look like. So it is a smaller body. At least one of the previous candle, it needs to be a smaller body that is fully engulfed with a new bullish candle. So this candle needs to be bullish, and this can be any color, but it needs to be fully engulfed. So as you can see right here, we have our opening price at the bottom and our closing price above it, and we're fully engulfed this small candle right here. So the bullish engulfing bar pattern tells us the market is no longer under the control of the sellers, and the buyers will take control of the market. So when the bullish engulfing candle forms at the end of the downtrend, another downtrend, as you can see right here, we have in our downtrend, we are starting a new upper trend. So how this was confirmed, we can see right here, we have our bullish engulfing candle. We had this small candle right here being fully engulfed by this bullish candle, and that was a confirmed uptrend. And as you can see right here, we actually had the market going up, and it started really going up. So when a bullish engulfing candle forms at the end of the downtrend, the reversal is very much powerful. But at the same time, if this candle forms at the end of an uptrend, that means it's an indication of continuation signal. So if this was an uptrend, ongoing uptrend, but then we saw this pattern coming up here, that means it's another opportunity for re-entries, meaning that you just continue to ride this wave right here, going further with it, because the market will be continuing and the buyers are still in control of the market, so they'll continue to push the market up. So The example above shows us clearly how the market changes direction after forming a bullish engulfing bar pattern right at the end of a downtrend that was going on. The small body that represents the selling power was covered by the second body, which represents the buying power. So the color of the bodies is not important. What's important, the smaller one is totally engulfed by the second candlesticks. So don't try to trade the market by using this setup alone, because you need other factors of confluence to decide whether the pattern is worth trading it or not. So you need other technical analysis for you to have a confirmed position that you can trade this setup right here. So the most important step is to do now is to develop the skill of identifying the bearish and the bullish engulfing bars on the chart. So you need to find this on your chart as many times as you can. So once you get used to actually seeing these candlesticks, it'll be much easier. So take a moment to actually just go on your chart and try to find these on different time frames and get to see what they did, whether it was a continuation pattern in a downtrend or in an uptrend, or it was actually a turnaround moment after a downtrend or after an uptrend occurred. So our next candlestick that we're going to take a look at is called the Doji Candlestick.